Welcome to This Explainer. Today, we're peeling back the curtain on the multi-billion-dollar theme park industry to reveal the hidden financial engines actually driving your summer vacation. You know, we all love the thrill of the rides and stepping into those deeply immersive worlds, but the actual business of running these sprawling entertainment cities, it is way more complex than just selling a ticket at the front gate. The core financial pillars of this industry rely on a fascinating mix of massive capital investment, strategic revenue diversification, and just relentless operational cost control. Which brings us to a really crazy paradox in the market today. Right now, we are seeing some major regional operators entirely shutting down parks and auctioning off their land. Yet, at the exact same time, other players in the industry are experiencing the most profitable years in their entire corporate history. How is that possible? Well, we're going to answer that by looking past the roller coasters and exploring a high-stakes ecosystem of big data, massive debt, and real estate realities.
All right, Section 1, the price of admission. Let's get right into it.
Before a single guest even buys a churro, the financial mountain you have to climb just to open a theme park is, honestly, it's mind-boggling. The industry calls this upfront investment CAPEX, or capital expenditure. And it's a continuous cycle because parks require massive, ongoing investments every 3 to 5 years just to drive attendance spikes. To put the sheer scale of this into perspective, Universal Studios Japan spent $500 million on just one single themed land expansion. That wasn't for a whole new park, mind you. That was just one highly immersive expansion to keep their attendees coming back. Industry consultants actually use a pretty blunt formula for this today. You basically must budget $500 per expected guest for modern immersive storytelling parks. On the flip side, a standard ride-focused regional park requires about $200 per expected guest. And here is the real kicker. The rides alone typically eat up 30 to 60% of your total construction budget. That is before you've even laid the plumbing for a single bathroom or food stand.
Moving right along to Section 2, beyond the ticket sales.
Here's a wild thought. That front gate ticket? It's often just a decoy to get you inside. The industry figured out decades ago that there's a strict ceiling on what families will pay just to walk through the front door. This is exactly why the season pass completely changes the financial model. Parks use these heavily discounted passes to secure upfront cash flow and guarantee attendance. Think about it. Once families buy in, their marginal cost to visit again is literally zero. They've already mentally written off the ticket cost. This essentially transforms the park into a reliable subscription business. They don't actually need you to visit once and spend big. They need you enrolled, coming back constantly and spending in small, continuous amounts.
So where does that continuous spending happen? Well, once you're trapped inside for 8 hours, you're essentially a captive audience. And that drives incredibly high-margin secondary spending. And it doesn't stop at the gates. Major operators use resort operations, meaning owned hotels and expansive dining districts, to capture multi-day tourist dollars. A family might only spend $60 on a base ticket, sure, but then they easily drop hundreds more on premium parking, a VIP skip-the-line fast pass, and a severely overpriced turkey leg. In a lot of ways, the multi-million-dollar roller coaster just exists to get you close enough to the cash register.
Okay, Section 3, the cost of magic. Running these places is basically like running a small city, and it requires a delicate balancing act. You're walking a constant operational tightrope. Parks have to balance those continuous, massive CAPEX investments in new rides against absolutely crushing fixed costs. We're talking year-round property maintenance, liability insurance, debt servicing, a huge permanent staff. Those expenses do not go away just because it's a slow Tuesday in November. And all of this has to be balanced while trying to manage unpredictable variable costs, like seasonal labor, utilities, and raw food, which constantly scale up and down with visitor volume. But you know, the biggest threats aren't always on the spreadsheet. Sometimes they're right up in the sky. For regional operators like Six Flags, which carries nearly $5 billion in debt from recent mergers, a single unusually wet or hot weekend can completely gut their attendance. When your fixed debt remains exactly the same, a rainy Saturday wiping out your gate revenue is catastrophic. This is exactly why parks now rely so heavily on dynamic pricing. They are continuously adjusting daily admission costs based on forecasted demand, upcoming holidays, and yes, the weather, just to squeeze out every possible dollar when the sun is actually shining. Which leads us to Section 4, optimizing the guest journey. To fight back against those massive fixed costs and uncontrollable weather risks, park management has evolved into an intense, data-driven science of capacity optimization. Operations now have to balance creative magic with rigorous, hard metrics. They closely track numbers like RevPAG, revenue per available guest, to ensure the park is maximizing its financial yield for every single visitor. Think about it. If a guest is just standing in a physical line for 2 hours, the RevPAG drops to zero because they aren't out in the park buying merch or eating food. So how do they fix that? It's all about real-time workflow optimization. By shifting guests into virtual queues on their phones, they aren't stuck standing in physical lines, which frees them up to shop. Then, by tracking guest movement with heat mapping, the data systems can see exactly where crowds are clustering. If one zone is getting too packed, boom, the Parks app can dynamically trigger a push notification offering a 20% discount at a restaurant on the complete opposite side of the park. It load balances the crowds automatically and drives them right back to the retail stations. It's honestly brilliant. And this optimization even extends to the rides themselves. Parks are now utilizing AI and IoT vibration sensors on ride motors for predictive maintenance. Instead of waiting for a part to break during peak hours, which causes highly expensive unplanned downtime and incredibly frustrated guests, the AI flags potential failures early. This allows crews to fix the issue overnight on a Friday, keeping the rides spinning all through a busy, highly profitable Saturday.
All right, Section 5, the power of IP.
Despite all this incredible digital optimization and capacity management, long-term survival in this industry often just comes down to what you own, specifically your intellectual property, or IP. The global theme park market is booming right now, projected to reach over $150 billion by 2034. That is massive, sustained growth. But the reality is that the lion's share of those soaring profits goes directly to the operators armed with the best global IP. That's what drives both the crazy merchandise demand and the immense ticket pricing power. Look at this massive divide right here. In 2025, Six Flags suffered a 70% stock drop, largely because they were exposed to commodity real estate, high debt, and bad weather. But during that exact same tough travel year, Disney posted a record $10 billion operating profit for their experiences division. Why? Purely because they own exclusive IP that families will gladly pay a massive premium to be near, regardless of inflation or the broader economy. Nobody else can legally build a ride around their characters. That is the ultimate economic moat.
Finally, Section 6, the real estate reality. So, what happens to those regional parks that unfortunately lack that globally recognized IP moat to protect their margins? Well, major regional operators are currently closing locations. Six Flags recently closed parks outside Washington, D.C. and in California. Then, they sold 7 parks outright for $331 million. But here's the kicker. They didn't sell them to another theme park operator. They sold them to EPR Properties, which is a real estate investment trust, or a REIT.
So the crucial point here is that these buyers, they look at theme parks simply as tenants paying rent. This exposes a fundamental reality of the industry. The theme park exists on the land first, and the rides are just the highest yield use of that dirt at this particular moment in time. The real asset all along has always been the real estate.
As we wrap up this explainer, I want to leave you with one final thought. Every theme park you visit is really 2 massive businesses stacked on top of each other. A highly optimized, data-driven ride operation and a massive real estate holding. So if you're looking at the theme park industry from a business perspective, you really have to ask yourself, if the coast